Hey everybody, Colin Plume, CEO Noble Gold Investments, and we're here on an exciting day right before Liberation Day tomorrow. And I got my friend Micah here, who's
Hey,
going to
boss.
talk everything liberation over here. So pretty exciting, unprecedented day tomorrow, right? I mean, what do we think is going to happen? What's already happened?
Yeah, so it is a big day. I think everyone's kind of waiting to see exactly what comes out of the press conference tomorrow in the Rose Garden at the White House. Lots of anticipation, lots of kind of preemptive pre-positioning from Trump as well on this. But really, Colin, you know that since, let's say, December, talk of the town's been all about tariffs, all about tariffs. And, it's been a fairly unpredictable landscape. I think what tomorrow is going to be actually really meaningful for is figuring out exactly what's happening now moving forward. Tariffs have been on, they've been off. There have been some exemptions provided to countries like Canada and Mexico, but we know those are coming off now tomorrow, and we'll know what the real plan is with concrete steps to reduce these trade imbalances and to move forward. So we really need to just kind of keep in mind that Liberation Day is signaling a major policy shift in U.S. trade. And we're going to be seeing, sweeping tariffs on imported goods. But the goal here is to bolster our domestic economy and to bolster manufacturing and to bring jobs back and make America great again. So will that be smooth sailing? We'll find out, and we'll get into that today. But I think that ultimately this is setting kind of the U.S. on the right track for the long term. And so there's a few things for us to discuss. But do you have any particular insights to what's going to happen tomorrow? Any thoughts on the direction he'll take?
No, one thing on cars that's interesting that will be okay. So let's say there's a 20% tariff on Mercedes Benz, for instance, right? So just use easy math. Let's just use it's $100,000 Mercedes Benz. It's worth $120,000, or they have to price it at $120,000 to cover the tariff, or $125,000. It doesn't really matter.
Yeah, 25%.
What is the bank? How does the bank lend on that? Because if you're a bank and you're like, okay, what if he pulls back the tariff, right, in a month or two? And so what would happen is if you gave somebody a loan based on a $125,000 car, and then he pulls back the tariffs, then the car's worth $100,000.
Yeah.
Right.
So you're now negative equity right away.
Right. Exactly. So let's say you on that car, you said in a normal scenario, someone would have to put $20,000 down to qualify for that $100,000 car. But now you don't really know what the value of that car is going to be, because it's really such a substantial amount, and the margins on cars are pretty small. So I don't think it's not like Mercedes-Benz can just eat that 25%, right? It's not feasible. So I think in the car market for new cars, it's going to present a lot of financing issues because the banks are going to be wary. They're going to want to protect themselves so they don't have a bunch of cars that come back that have negative equity, is what you're saying.
And that's a good point. That's a really good point. I would hope that, keeping that in mind and being a super smart finance guy, Trump probably knows that all the wishing and washing on tariff policy for the last couple months, he probably can't do a whole lot more of that moving forward for the sake of businesses, for the sake of banks, for the sake of consumers.
It's better to stick it out, right? To just ride. That's my big question of this whole thing is like, could we get some guidance on, let's run this thing through the end of the year, right? Or something, that would be ideal.
Yeah.
To have like some kind of timeline. And I think that's better. I think everybody just wants it to be consistent. I think that's the goal. And businesses need it to be consistent, because that's the whole thing, is that like, if you go to a car lot for Mercedes-Benz, for instance, and, you're looking at, those cars or maybe Mercedes-Benz even has some cars that were made here in the US. They might have some cars that were made. When you go to the lot, you're going to be looking at which one do you buy, which one do you push,
Yeah,
and it's a lot of money. We're talking about, this is a big part of our economy. So I
absolutely.
think it's something to think about.
I think what you said there is key, that there's going to have to be consistency. Implementing the Liberation Day trade policies tomorrow, the hope would be that they are set in stone for a couple of years. Because as you know, a business making decisions about, bringing back production, making some expansions, capital
Right.
investments to bring jobs back, make more materials here at home. Those things are not going to be easy to make if there's not that
Right.
stability in being able to make those decisions. And of course, what I think Colin has been sort of making for the year, or at least the start so far, very turbulent and tumultuous for the stock market, has been all of the uncertainty. So, we've seen signs of drawdowns. We've seen the S&P, the NASDAQ, the indices in general are down about 10% or so from the beginning of the year. And I think that if we're going to see the stock market stabilize, we have to have that consistency. And you and I have talked in the past about whether or not they're trying to engineer a bit of a stock market correction for the sake of bringing down the 10-year. But we're going to see tomorrow whether or not there's some expectation on things being set in stone. Now, one of the other things that I think this is going to do is we're going to see price hikes across the board as far as goods and services go. Things from food, clothing, apparel, autos. We talked about luxury autos, especially in a European made car, Volkswagen, Lexus, Hyundai, all these Asian manufacturers. We're going to see price spikes across the board, which some will say is going to lead to inflation. If you take kind of a Austrian economics sort of perspective like I do, where the economy is a closed system, as long as there's no new money being injected in there, a price increase just takes away money from other things. So it's actually going to force consumers to be a little bit more prudent with the decisions that they're making. Costs are going up over here on some of my essentials. That means less money for other things in my budget. So we could actually see demand across the board go down. Now, it's not going to be on everyday items like food and clothing and energy, but we're going to see probably some consumer decisions being made that could lead to a recession as well.
Hospitality. Yeah, I mean, I think eating out, I think things that are not necessary are probably going to suffer.
Yeah.
As people are going to tighten their belts, and that would obviously make sense because consumer sentiment last month has been so bad. I mean, it's been so down. So people, I think, are sort of bracing themselves for this slowdown.
Absolutely.
And focusing, on the essentials will cost more, so they're not going to have as much
to go around.
Yeah, to mess around with extra
That's
cash.
Right. That's right.
To throw around.
Now, another interesting piece of this is going to see how everyone reacts in terms of our trading partners. So there is obviously a risk of escalating, trade tensions, risks of a trade war. What Trump is doing, in all fairness, is deserved. He is simply saying, we're introducing reciprocal tariffs on countries that already have them on us. We're essentially leveling the playing field for Americans. This chart here shows us, in terms of each of our partners, they're color-coded at the bottom, China being the largest. We're able to see the current trade balance. So we've got a negative trade balance with all of our top 10 trading partners. And so the idea is that if we can buy less abroad and produce more here, we're going to reduce those trade imbalances. And there's just no knowing how they're going to react. I mean, again, he's coming from a place of fairness. You already have a tariff on me up here. I'm simply coming and meeting you there.
Right.
But, in the case of Canada, for example, they have egregious tariffs on dairy products. They have egregious tariffs on other things. And we're talking hundreds of %. They effectively shut out all American products from the Canadian economy as far as dairy, cheese, and those types of things go. So we would have to meet and match that, hundreds of percent tariff just to get to a level playing field. But from the rhetoric that's coming out of the Canadian election that's going on right now, they see that matching of tariffs as an escalation or an introduction of tariffs. So they want to go even higher. So that's just one example of how this could lead to trade war risks, escalations, and those types of things. So, one of the things,
and that's a big reason why I wanted to do this today.
Yeah.
Because I think there's been so much information out there that, it's been, somewhat complicated as to what's going on. And I do think the idea that it's just we're trying to create a fair ground for us to be able to send our goods overseas, and hopefully things balance out, right? There's going to be a reaction to, listen, everybody wants our dollars, right? They want it. We're a massive consumer in the world. So I think us getting to more of a level playing field, and the idea that we bring more manufacturing back here, we create more products here, buying American products. I shared this story, I think, in one of the live streams, that I do this Shark Tank with these sixth graders at my kids' school.
Yeah.
And a few years ago when I started, every product that they created for Shark Tank, they made it in China or Vietnam. And I playfully said, we make stuff here too, right? And one of the grandparents in the audience started cheering and getting all excited. And he was a Vietnam vet, and he was like, as you said that, I was thinking that, because we've been brainwashed to think that as business owners, we have to make something overseas because we need that margin. And this new idea that we can make it here is going to take time. And that's why I think he's been so aggressive with the percentages, President Trump, because we really need to set a new mindset in the United States, and this idea that we need to make our own products. And it needs to be an aggressive push, because we went the other way in the 70s, right? We started sending everything overseas, and we thought it was great, and it was great for the 1%. But it wasn't great for the middle class at all. I mean, we've really, the middle class has really suffered since we started to make so many products overseas.
Absolutely. So I think you're right. It's going to take time. With the right policies, we can start to reshore a lot of that manufacturing that we lost decades ago. And one of the interesting things is to try to think about what are going to be some of the industries that stand to gain the most. Just a few examples. Obviously, automotive, if we can get more production here, those are high paying jobs.
Right.
It will take a while because there's so much infrastructure involved. There's so much material sourcing that's involved. And we have right now a fairly integrated automotive industry with Canada and Mexico. For example, parts are made in Canada, then they're shipped here and they're reassembled a little bit further. And then that part is sent back to Canada and same thing happens in Mexico. There's a lot of car production that happens in both those places, but those are some of the probably first places to be impacted. The worst is the auto manufacturing plants in those two countries. But now we're going to see Ford and GM and these major plants bring everything back here, and that'll produce a ton of jobs, a ton of economic growth. That's going to help us in the long run. That's just one example of industries that stand to benefit. Now, in 2018, Colin, when Trump introduced the first steel tariffs, at that time, what we saw over the next 2 years was American steel production increased by 8%. So it had the desired effect. It just took a little bit of time. And I think that's probably what we're going to start to see in some of these other areas. We just have to figure out how quickly we get there and with how much kind of economic pain or uncertainty in the meantime. And that's another big topic here, is as good as this is for the long-term vision of the country, making America great again, reshoring all these jobs, what does it do in the shorter to medium term in terms of potentially pushing us toward a recession or a period of prolonged inflation?
Yeah.
We already talked about how it'll affect consumers. Higher prices mean that we're going to see less money going around. But if it goes beyond the consumer and starts going into businesses, seeing declining growth, that'll all sort of lead to a lower GDP number, and a declining GDP would be recessionary. And then that puts us into are we going to experience a multi-year recession as we go through this multi-year expansion? So that's just one of the things that I think is yet to be determined too, but it'll be a very important consideration for our clients and investors, right? Is what's happening to the U.S. economy over the next few years. Maybe it grows like crazy in 5, but we've got to get through this next period, especially if you're coming up or already in retirement. Very, very important.
Yeah. While we're talking about that, I know, Ryan, you got a new video that was kind of interesting. I don't know if we want to pop that up here. This is the White House press secretary here. Let's see if we can get this. This is pretty good. Let's see if we can get that.
Love her, by the way. She's doing such a great job so far. She's so feisty.
Absolutely. Yeah.
Love it.
Yeah, here we go. This will be good.
Fair trade practices that we have, 50% from the European Union on American dairy. You have a 700% tariff from Japan on American rice. You have a 100% tariff from India on American agricultural products. You have nearly a 300% tariff from Canada on American butter and American cheese.
Yep.
This makes it virtually impossible for American products to be imported into these markets, and it has put a lot of Americans out of business and out of work over the past several decades. So it's time for reciprocity, and it's time for a president to take historic change to do what's right for the American people, and that's going to take place. Look at the
That's bang on, and that I'm glad that I'm sort of verified by her saying that Canada has a hundreds of % tariff already on dairy. We're really just meeting them where they already have tariffs on us. So you can see how so many markets are impossible for us to basically tap into with these preventative style tariffs, and that's all by design, right? So that'll be
and I think part of this is reframing our thinking, in that because these tariffs have been so onerous, that there's probably a lot of people in the U.S. that have just avoided trying to sell their products to these places, and that's that's why I think this is really interesting. What's going to happen tomorrow? Because will we be creating, if some of these countries start to pull back the tariffs that they're charging on our products, does it create a whole new revenue stream for business owners here in the U.S.?
Yeah.
And I think I wish, honestly, they had gone into this earlier, because I think if they'd started having these conversations over the last 2 months, people would have been more open to the idea, but they've just started to
kind of pull back the curtain on what other countries are doing. So I know it's been perceived as, us kind of shaking a big stick. We want to impose all these tariffs.
Sure.
I think the messaging, you're right, probably could have been a little bit more strategic from the get-go, from the jump, saying, look, we're not actually imposing anything that doesn't already exist on us. We want to tear down trade barriers. So unless they want to remove their tariffs, we're going to meet them where they already have us. So
what do you think about this question? How is this allowed? Why did we allow this
to happen to us? Yeah, to happen to us. Basically, Trump's hinted at this previously, saying, we've made a bunch of bad trade deals, more or less glossing over the fact that he actually had, one term to maybe, take the axe to a lot of these tariffs and bad trade policies. So I just think over time, like you said, Colin, globalism and the benefits of it were sort of short-sighted, but they were very real. Cheaper products, fantastic. Who's going to complain about that?
Sure, right.
Better business margins. No company is going to necessarily balk at that either. So, we've got cheaper electronics, cheaper goods, cheaper clothes, cheaper everything. And we've experienced deflation in a lot of these kind of common day goods because of globalism. But the long-term negative effect has been that we've kind of gutted industrial America. Yeah. And it's not a sustainable trajectory to be on, to just be this massive consumer nation that's not actually a major producer nation. Now, we do produce a lot of stuff. We've got a fantastic, diversified and strong economy, but it's not where it could or should be. And that's sort of what I'd say, is it just kind of that slow roll of people aren't really complaining over the years of having cheaper and cheaper products, but then all of a sudden you realize there are these massive areas throughout the country that used to have a lot better jobs and a lot better paying jobs. And we want to bring that back.
I would argue too that a lot of people always say that Trump aligns himself with business, but I would say that a lot of businesses are not happy with this. Because
In the
they've been
short
able
term.
to profit so much at
Yeah.
an American expense, right?
Yeah.
Like regular American expense. And so I would argue over the last 20, 30 years, while we've had these since the 80s, almost 40, 50 years that we've been doing it this way,
Yeah.
we've really benefited big business. And in a way, this tariff policy, and why a lot of politicians didn't want to do it, is because they were getting paid by huge corporations. And so that's why no one's ever wanted to do this. Whereas Trump said, listen, in terms of actual business and middle class, the bigger benefit of this is in the middle class. The middle class will benefit the most because, like you said, you bring back jobs for car manufacturers. Those are high paying jobs. You start being able to send cheese and milk, and we can be competitive in Canada. We can start manufacturing more of those things here. So it actually creates higher paying jobs, which is what we actually need and I would argue with all AI and everything happening, like jobs are getting pulled away. We need higher paying jobs. We need these kind of jobs. So it's kind of interesting, like what people have said about Trump. And you could make some arguments. Obviously, he has connections to big business, but also I would say this tariff attempt, what he's doing is actually, it's going to piss a lot of big business off. It's actually not in the benefit of big business. They'd love to just keep sending everything overseas at a cheaper price.
Yep.
And just see huge gains.
But
obviously,
I think
gold is okay. Go. How long will we feel the benefits of the tariff? Is the next one.
Hard to say, right? So I think it depends on how quickly the business landscape adjusts. It also depends on whether or not we have to experience any kind of growing pain, so to speak, over the course of that adjustment. So tariffs come in, maybe the counterparty of that tariff reduces theirs on us and they go away and we have better, freer trade right away. Maybe we end up in this kind of escalated, intense trade war that lasts several years where it's tit for tat and it really hurts consumers. It's probably too early to say. I really do think time will tell, but these are developing fast. I mean, look at all that's happened in the first 70 days of the Trump administration. I think we're going to see things move pretty quickly here for better or for worse. But again, it puts us on the kind of the right track long term. So I think we're just gonna have to kind of roll with it, see with it, and
my gut is we got 2 years minimum. We got 2 years of pain. I think. I do think it's going to take some time, because if you're talking about moving manufacturing back, it's going to take time for these companies to make those moves. But I think they're going to start announcing this year that they're going to building factories in different places and they're going to start making products here. It's all going to happen.
Yeah.
But for us to see it, it's going to take a while. They said, what is 140, 150 billion in tariff revenue. So it's not a huge amount.
Yeah.
But it's more of a psychological step. Gold has been moving. Best quarter in, I think, 40 years, the first quarter this year. Do you think
a $500 move just in the last 3 months?
I feel 20%. Like every day it's a new all-time high. Do you think that it was already the tariff, what's happening is already priced in, or do you think that there's more room, or what are your thoughts?
I think there's a lot more room, but the tariffs have been playing into it so far. I think that central banks and the buying trend that we've seen for the last several years, Colin, and you're acutely aware, central banks in the eastern part of the world have been buying at record levels for, I think it's 4 or 5 years now. Really, it's since COVID. I think that's signaling the longer term strategic movement back to some type of gold standard, or gold being treated as a tier 1 asset, which it is, but it's really more of an implication of gold being regarded by the rest of the world as a monetary metal more than anything. And kind of shoring up their reserves and strengthening their balance sheets with gold on it. We've seen an enormous amount of metal move since Trump's election. It's like over 2,000 tons that have been delivered into the U.S. in the last 3 months. Totally unprecedented. Part of it is the speculation on whether or not gold and silver are actually going to be exempt from tariffs or not. And so silver as a hugely important industrial metal, we've seen quite a bit of it come in as well. Not quite as much in terms of the volume or the amount of gold that has come in, but silver is also being delivered into the US en masse. It's hard to say if tariffs are the real reason why. It's almost like a convenient reason. It does explain some of it, all the metal trying to come into the US prior to tariffs coming in at the risk of them being subject to 25% tariffs as well. But I also think there's a larger, bigger picture thing there that's not as, it's not as narrow as just tariffs. It's a larger global move back to having gold and gold reserves being a priority, not just for countries, but, obviously individuals as well.
Yeah.
Want to just protect their wealth.
Yeah. And I was talking to somebody about gold. I just want to be clear. It's above 3,000, not 2,000. I was talking to somebody about this recently, and they were like, "Oh, above 2,000. That's not. It's above 3,000." And I think it moves so quickly that some people miss the move above 2,000. They missed it at 2,500.
Oh,
and they're shocked by where the price is. So we are at $3,132 spot price.
It's kind of mind blowing, Colin. As you know, lots of clients have bought sub 2,000 who are just ecstatic, and that's not that long ago. That's 2 years ago in some cases, 1,800, 1,900.
Yeah,
but we've all got the client that's at 25 when I talked to them in December. Right, $2,500 gold was in December, and I said, "Hey, look, things are going to get pretty spicy here with the new administration and potential recession and all this other stuff. Nah, go ahead and call me when we get call me at 2,200," thinking that it was just probably going back there rather than breaking up as much as it did. So I think we have put in a very significant move. Any market is a 2 steps forward, 1 step back. I would probably. I'd say a couple things. I think there's room for us to see something like 32, maybe 32.50 over the coming month, but we are very likely going to have to let off some steam, and something that's referred to as like the overbought condition. It's gone up too far too fast in a sense. So I actually believe there's going to be not a huge buying opportunity, but we're probably going to retest that 2,800 level, right? So you break through resistance, you have to come back and test it as a floor, 2 steps forward, 1 step back, 2 steps forward. So that's kind of what we're on. But I think every bank is pretty much agreed on $3,400, $3,500 gold later this year, which is insane because most banks have the most conservative projections possible.
Sure.
Even in a bull market, they'd put maybe a 5% increase on it at most, but they're all more or less in unison at that $3,300 to $3,500 mark for later this year. So there's still lots of room to run in the short term.
Yeah. Let's go to something, and then we'll talk about Buffett, what he's been doing, which has been pretty interesting.
We're talking to people today about investments. Let's see if we can get somebody. Excuse me, sir. Do you have a retirement account?
I do. I'm invested in some annuities.
Fixed income? How is that?
It was better a few years ago. Each year, it buys less and less, barely keeping up.
That's where gold can make a difference. Unlike fixed payouts, gold rises with inflation, so you're not stuck with a low fixed payment.
So gold isn't stuck in the past like my annuity?
Don't let inflation erode your retirement savings. Invest in gold. Invest with Noble Gold Investments.
Let's talk about Buffett. He's been
hoarding cash, hoarding the most cash he has ever held. Berkshire Hathaway has never had this kind of stockpile of cash ever before. And this didn't just start in the last, let's say couple weeks where the market's actually been down about 10%. This was all pretty much baked into the pie before the market even started correcting, while it was still at all-time highs at the end of last year. Obviously he's a wizard. He's an absolute legend. Going back, 60 years, he has probably one of the most stellar investment careers of anyone still alive. And it's got to be a telltale sign to markets in general when the smartest guy in the room is sitting in record cash. Yeah. And then obviously the last few weeks really just kind of validate his positioning. So I think if he were to start redeploying, that would be a good sign. I don't think we're anywhere near that. And it would be my bet that he is probably sitting on this cash position, not just for the remainder of the year, but probably likely into next year as well.
Yeah. And it's interesting what he's been selling. A lot of bank stocks, Bank of America, Citigroup. He has come out and said that he's just looking for opportunities, like sort of alluding that he doesn't want to.
He's a market mover, though. He has to, like he
Right.
can't say, I think this thing is cooked,
Right. Because like he's selling Bank of America, Citigroup, but he doesn't want to say that they're not strong stocks. He just says he's accumulating cash and waiting for opportunities, which is a really political answer, because a guy like him, if he says, I think the stock market's going to drop 40%, it would drop a little bit just based on him saying so.
Oh yeah.
Right? Wouldn't that happen?
Oh, agreed. Like, he's the closest thing to a celebrity investor.
Yeah.
And I actually, love the guy. Never really studied his work all that much. I know guys who read through his annual reports like religiously. Lots to learn there, don't get me wrong, but I always feel like he's been quite a managed kind of character as well. It's like he can't really say anything that goes against the mainstream narrative to an extent, because he can move markets with a single comment. And so
he was much more bullish in 2010 with his comments. In 2009 and 2010, he was like, U.S. equities are still affordable. It's a good price. I mean, and he put his money where his mouth is. He kept them there. And he was buying more. This time he's been tight-lipped and just selling. And
the timing.
Listen, why would the greatest investor in the world sell stocks? He doesn't want to sit in treasury bonds.
No. Well, not for the long term. But he, as much as you don't want to, time the market, and it's more important to spend time in the market. It's like the eighth wonder of compound interest or whatever. That's why he's done so well. But before the 2008 crash, he had a fairly significant cash reserve as well. Like at that time, it was one of the largest that he held to any time prior. And then you're dead on in terms of the timing in 2009 or 2010. At that point, not only did we hit the bottom of the stock market and we're actually on our way to an economic recovery, but that actually is something the country really needed to hear to reinstill confidence in retail investors as well. And so right now, he's all cash. He's probably going to sit tight for a year, maybe more, see how the chips fall. But for me, that says, if anything, that this last few weeks and the 10 or 12% correction that we've seen is just the start of it. And my opinion is we'll probably actually see a recovery probably over the summer. We probably even see a marginal kind of all-time high. So we could go up 10 or 12%. If we're down 10 or 12%, we'll make a marginally new high. But this fall, I think, is when we're really going to see a fairly significant correction. I think this sort of spring crash has just been a bit of a teaser to what's to come, and not to tie it into the tariffs. But if we do see like economic shocks across the system because of what's happening with Liberation Day tomorrow, it could be evident that corporate America is suffering in 6 months or so, which could lead to worse earnings, worse margins, lower cash flow. And, we could see a fairly significant correction from there. So obviously knocking on wood and no crystal ball here, but that's just my feeling of it.
Yeah. And to get into the next thing we were going to, Buffett, U.S. equities selling, getting to cash. Now there's been this huge European exodus where U.S. investors are doubling down on European investments. And it'll be interesting to see if that strategy works. I think this debt bubble we're having is everywhere, this unbelievable amount of debt. But there is a pretty significant argument just in terms of the PE ratios, if you follow those things, that, Europe may have some opportunities. So we're seeing a lot of people, pull back.
And moving capital over there. Yeah.
Yeah.
And I would add to that, because that's absolutely correct. I'd add to that, part of it is Europe's been in a fairly significant kind of recession or, stagnant kind of economic condition for several years, really since kind of like, let's call it COVID time. And the various indices, the German stock market, for example, has rebounded a lot really in the last month or so because of these talks about war escalations with Ukraine and Europe. And not only that, but a lot of the various countries, Poland, France, England, have all jumped on the bandwagon saying, we're going to start stimulating the economy. We're going to start spending a lot more on defense. We're going to have a lot more money pumping into the concept of us potentially having to go to war with Russia to defend Ukraine. And so that's just this, at the bottom line of it is it's stimulus spending. And so these contracting economies are now seeing huge inflows of government cash. Now, whether it's for defense or other things, that's just sort of leading to a bit of a bump there. How that all plays out is also going to be really interesting, Colin, just to see what happens with these peace talks with Russia and Ukraine, and how we're able to make some progress on that, or whether or not we are at all.
Yeah. And some interesting facts coming out. Fund managers have dramatically reduced their overweight positions in U.S. equities by 40 percentage points in the single month. One of the fastest shifts in allocation in market history. So that just happened. And there's a profound loss of confidence in U.S. exceptionalism. 69% of investors now believe America's economic dominance has peaked. So there's been a shift. There's the people are moving. And that's the thing we've always talked about. Wealth just moves, right? It goes somewhere else.
Capital rotation.
We're moving that. And, I think the thing too that, we've been talking about a lot is what's going to happen for investors here in the U.S. when they get that first quarter report of their taxes, right? I mean, of their 401ks and their
statements,
their statements, right? Because a lot of people, they're not looking at it like we are. And so
every day,
I think they're probably going to be down anywhere from 9 to 12%. Some maybe higher in this first quarter, depending on what they're invested in. That'd probably be the average. In my 401k, that's when I'm down. So I can say that that's pretty consistent. I think that that's for people that are closer to retirement. They're starting to look at this a little bit closer. Maybe they're looking at it monthly. It's going to give people they're going to have to start thinking
food for
what's
thought.
going to happen the next 1 to 2 years or 3 years. Do I reallocate? Do I move into something different? And so I think not only the price going up the gold, but I think that is a big reason why a lot of people have been calling us, is they're doing this reallocation
and diversification, protection, wealth preservation strategy. And you're right, these active managers, like you quoted in that stat, they've been rebalancing positions because end of December the US stock market was the most expensive it ever was. On the other hand, Europe's has pretty much been in the dumps, so they see it as a sell high, buy low. And that trade's playing off as capital flows. But the gold space is also benefiting from major capital rotation. I think that trend, as I've discussed and shown on some very long-term charts, that is only just like the very, very first inning of that. We're going to see probably another 5 to 10 years where the precious metals market cap continues to grow at the expense of equities being sold off. But you're right. Our clients are acutely aware of especially those that are in retirement or planning for retirement. They're acutely aware of what their financial positioning is and looks like. And they're at a point now where, after Christmas, things looked amazing. It's April Fool's Day now, and they're looking at their Q1 statements for 2025, and they're down, 9 to 12%. So the thought about, riding this further down, if that's the trend for the next quarter, like I said, I think it might recover a little bit here before a larger dip. This is the perfect time for clients to be having those conversations with their financial advisors, giving us a call, starting the chat about how to protect themselves, what the benefits are of being in physical metals. Diversifying your portfolio is a smart strategy at any time, but it's crucial times like this, Colin, that it makes the most sense. And I'd urge our listeners to give us a call today. You can talk to me. We've got a great sales team. I'm just one of about a dozen that are very qualified. We're all physical metals investors as well. So anytime you want to have a conversation with me or anyone else, just give us a buzz. Happy to help.
Absolutely. Yeah, Micah, thanks so much. A lot happening. Tomorrow is an exciting day, Liberation Day. Hopefully this answered a lot of questions, because a lot of people were asking these questions. Hopefully we dive into it a little more. Obviously we'll know next week more's happening.
Yeah.
But I think our goal hopefully is that it's a consistent message, that we consistently put the gauntlet down, we do the tariffs, and then we, businesses react and everybody reacts to what will happen there. But very exciting. Gold all-time high, pretty much on a daily basis, which is great. Anyone has questions, call Micah, call Noble Gold. Any other questions you guys have, let us know. And thanks for everyone that jumped in, and we'll see you on the next one.